welcome to another edition of the Heritage Wealth Planning YouTube channel. Today we're going to talk about taxes and more taxes. How exciting is that? Let me get rid of that right there. I came across this wonderful article on the taxfoundation.org website from just a few days ago that, man, I tell you, critically important. And it's going to be fun to share because I think you'll get a lot of good information out of this. So let me minimize myself, move my big head over. It's from a gentleman named Stephen Enton. Getting real with capital gains taxes by adjusting for inflation. And the minute I heard adjusting for inflation, my radar, my spidey senses went up because, as you know, if you follow my YouTube, if follow my blog, I hate the fact that Social Security isn't adjusted for inflation. It ticks me off because it's getting more and more people, middle class and lower middle class taxpayers, sucked into paying more taxes than they were told they would have to by our illustrious leaders in Washington, D.C. And that goes back multiple administrations, Republican and Democrat, doesn't matter. It annoys me. And I have other videos. I guess I got to do this side. Other videos when I just posted one just a few minutes ago, as a matter of fact, that talks about taxation on Social Security. So click on that guy. All right. So this one is the same thing with capital gains. They're not adjusted for inflation, which again draws more and more people, middle class and lower middle class, paying more taxes than they're supposed to. And lastly, thankfully, the alternative minimum tax was doing the same thing, sucking in more and more people. It was just wrong. And the new Trump Tax Act got rid of a lot of that, thankfully, because that was that, again, the AMT was really a bane of my existence. It was there really to get like the 30 people who didn't pay taxes in 1983 or something like that. So they had the AMT to get those guys. And now all of a sudden, everybody on their son who has any significant real estate taxes, and when I say significant, up in the five figures, which if you're in New Jersey, not hard to get. But if you had decent real estate taxes and state taxes and whatnot, you are now sucked in to the AMT as well. Certainly weren't one of those rich guys who didn't pay taxes in 1983. All right, so enough of that. So here's the article, Getting Real with Capital Gain Taxes by Adjusting for Inflation. Just to let you know, the Tax Foundation is probably the preeminent think tank on taxes that I'm aware of in the United States. It's just wonderful resource, tons of stuff on here. If you're interested in this, if you're a nerd like I am when it comes to taxation, if you're not, well, then that's what I'm here for. Come to the Heritage Wealth Planning YouTube channel, and I'll keep you in the loop on taxes, what you need to be aware of. But if you do want to look at it, man, just tons of stuff, and it's just great. So every time I get a notification, because I hit notify on the subscribe list, that's why I'm notified on new content they have. Do the same thing on mine. Hit notification. That way you'll be notified on new content that I have. But anyway, I got notified that they had this article, and I just took a couple days before I could read it. So I want to give you the highlights here. Inflation realized related gains on the sale of assets are not a real increase in wealth. Indexing the purchase price, i.e. the tax basis, for inflation would provide savers some relief from this type of tax on fictitious income. Failure to index the purchase price of assets increases the effective tax rates on savings and investments, depressing wages and employment because less capital is formed. Now let's keep going down. The issue for savers, to the extent that the prices of stocks, houses, or other assets rise only with inflation, there is no increase in wealth. I'm going to share with you an example here in just a second how that can affect you. And he does use a wonderful example here. Suppose one had bought $100 stock in XYZ Corporation in 1965 and sold it in 1981 for $110. This looks like a $10 gain. He bought it for $100. He sold it for $110. $10 gain, right? But because of inflation, it took $2.86 to buy $1 the same could get in 1965. That means the stock would have had to rise to $286 just to keep pace with inflation. Adjusting the purchase price for inflation, we see the investor actually lost $176 when you look at it in terms of 1981 dollars. Any tax that was collected on that fake $10 gain, what they call nominal, I call it fake because it's all adjusted for inflation, is in fact you're paying taxes on money you lost. It's crazy. So give an example. Calculator. 1961, it cost $1. 1960, it cost $1. 1981, same calculator, cost $2.86. If I invested in 1965 $1 in order to be able to buy this calculator in the future and hopefully make some money, in 1981, that calculator, because of was only worth $1.10 if I sold it, which means I pay tax on 10 cents, meaning I no longer have enough to buy the calculator. It's crazy. So again, calculator costs $1 in 1965. In 1981, that same calculator cost $2.86. If I had $1 invested in 1965 and only grew to $1.10, I cannot buy this calculator. I am priced out. My purchasing power did not keep up with inflation. Even worse, I had to pay tax on the gain of 10 cents. And the gain I put in scare tactics because it's not a gain. And I was not able to keep up with inflation. It's horrific. It's horrible. With inflation, real costs are understated. Taxable income is inflated and the taxes on real earnings rise. Many firms in the late 70s were paying tax even though they were experiencing losses. And that certainly did not help economic growth. The bracket creep problem was eliminated by the tax reform, by the Economic Recovery Tax Act in 1981, because they did adjust the income tax brackets for inflation. But as you know, they did not adjust indexing for capital gains, and they certainly did not adjust, as ever they haven't done, on Social Security taxes either for inflation. So you might be able to get a gauge of how this works when things are indexed for inflation, tax brackets in particularly. But other two things, capital gains and Social Security, was not indexed for inflation, which is just, again, a pet peeve of mine. So let me show you this chart he has, which is absolutely fantastic. Let me move my big mug out of the way there. All right, here we go. Yeah. Taxation of capital gains in the presence of inflation, a 10-year time frame. We have 4 scenarios with no inflation adjustment, i.e. the current code. He talks about that here. With inflation indexing, regular IRA, and Roth IRA. We have 4 scenarios here. So we're going to take a guy, he's shoveling dirt for a living. He makes $128 in income from that income of shoveling dirt, but he's taxed at 22%, which means he only nets $100 after taxes because he made $128 gross. He had to pay $28 to the IRS for taxes. He's left with $100, but he invests that $100. And in this case, in 10 years, we're going to assume, I got to go down here. Bear with me just a second, my friends. We're going to assume he got a nominal rate of return of 6.478. I'm just going to say 6.5 for simplicity. 6.478, of which 4.125 was real economic growth and 2.26 was inflation. So for nominal return with growth, you take inflation, add to real growth, and that's your nominal rate of return. So he invested that $100. Again, he paid tax on his income, which left him with $100, which he invested. And after 10 years, he's left with $187. His cost was still $100. He invested $100. And that's what his cost basis was. So he had an $87 gain. You take that, your gain, value of asset after 10 years minus your cost, has $87. So he went to sell the property because he just retired. So he said, I'm going to sell this stock now. I just retired. I'm going to have to pay tax on $87. And that tax is at 15% for long-term capital gain, which means it'll cost him $13 in capital gain taxes, which leaves him with $174 after taxes. So it was 187, left with 174 because he paid $13 in taxes. All right, you get that? Now, let's say if we indexed it for inflation, same thing, shoveling dirt, pays $28 in income taxes, left with $100 to invest. He invested at that 6.5% rate of return. It grows to $125. But because of inflation, in 10 years, prices rise by 25%. 25% is inflation. But because of inflation, we have to increase this by 25%. That's his cost. But with inflation added to the mix, when we're indexing for inflation, his true cost is $125, which means his gain is really only $62, not the $87 we have over here. Now that $62 is taxed at 15%, not the 87, which means he only pays $9 of taxes, which leaves him with 178 bucks after tax. $4 more than he had here. He paid $13 in tax there without indexing it, $9 with indexing it. That is a 29% increase in taxes to this guy. 29% because of the taxation, the laws that they are now, where they're not indexed to inflation. Again, a stealth tax. A stealth tax. Now let's go back to it. This is a traditional IRA, and I like this quite a bit. And he has a Roth as well. So in this case, he works. He's shoveling dirt, makes 128 bucks. When instead of actually paying income tax on it, he puts it all into a traditional IRA and is able to deduct the entirety of that amount. So now he's got $128 working for him. After 10 years, that $128 grows to $240. Unfortunately, the whole thing's taxable, all right, because you deferred it. You haven't made it tax free. You're just kicking the tax can down the road. But he's got to pay 22% on this because it's all taxable. So he takes a distribution now. He just retired. He needs his money to live on. He pays 22% on every single penny in there because every single penny that comes out of a traditional IRA or 401k is taxed as ordinary income. So he loses 22%, which means he has to pay 53 bucks in total income taxes, leaving him with a net of 187, which is significantly higher than these other two. Same thing with the Roth here, 128 of income from shoveling. Because the Roth is not tax deferred, there's after tax money. He still pays that 28 to Uncle Sam, leaving him with $100 that he can invest. The $100 grows at that 6.5% rate of return for 10 years. He comes out, he's now retired. He needs to take the income. He takes it from his Roth. It's worth 187 bucks, but because there are no taxes, that's his net, $187. The Roth and the traditional IRA in this regard are a wash. Now, if you read more of my books or watch my other YouTube channel on 21 reasons you need a Roth IRA, there's more than meets the eye here than what this guy talks about that I talk about quite a bit. A Roth has much more beneficial than just looking at it from this perspective in terms of relative to a traditional IRA. But I'm not going to get that here, so just read or watch more of my videos. But at the end of the day, the Roth and traditional each net him 187. This only net him 174, and this net him 178. So the current tax rules of not indexing for inflation are the worst that we have, and literally cost you money that you could have used for your own spending needs in retirement for sure. One of these things it does say is definitely take advantage of your tax deferred and or tax free accounts, because here is basically double taxed. You're paying income tax on the money you earned, which you use to invest, and then you're paying capital gain tax on the investments after you paid income tax on the money you earned to start the investment to begin with. For sure, as you're paying twice on that, even though capital gains are taxed a little bit less than income, it's still got to pay a second tax, where in these cases you don't, which is favorable for sure. So at the end of the day, the current tax law is not favorable to people who are banking on capital gain growth, because capital gains are not indexed to inflation. It's not favorable to people who are banking on Social Security income, because Social Security income is not indexed to inflation either when it comes to taxation on your Social Security benefits. And that's just a fact. So there are strategies which we get into in further channels and whatnot to compensate for that. But if you are thinking that your capital gain is a cat's meow relative to other sources of income that you can pull in retirement, I just highly suggest you think again and lobby Congress. Say, hey, man, just like you indexed the tax brackets for inflation back in, I guess, 1986, 1983, you need to index the capital gain taxes for inflation as well. And while you're at it, let's do the same with Social Security, okay? All right. Hope this is helpful. If you find this informative, give me a thumbs up. Put comments in there what else you'd like to talk about. The last thing I need is for retirees to be sideswiped with sudden taxation. And I'm telling you, folks, it's widows in particular that get killed when it comes to sudden taxation. And we're going to talk all kinds about that. The drawback is by the time you're retired, and then secondly, if you're a widow who's retired, there's not much you can do at that point. You got to pay the piper. And it's unfortunate that the IRS and our folks in DC haven't recognized the tax trap that many retirees fall into, and widows in particular. So I want to address that because I think it just bothers me. Comment, thumbs up. Don't forget to subscribe. Then, of course, hit that red notification button to be notified on further content. Hey, thank you for being on the Heritage Wealth Planning YouTube channel. Hope to see you again soon. Bye.